Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now, let's look at short straddle risk strategy for trading. Now, what is the short strangle? The short strangle option strategy is a limited profit, unlimited risk options trading strategy that is taken when the options trader thinks that the underlying stock will experience little volatility in the near term. Short strangles are credit spreads as a net credit is taken to enter the trade. So, let's look at the maximum profit that can be earned with this. The maximum profit for the short strangle occurs when the underlying stock price on expiration date is trading between the strike prices of the options sold. At this price, both options expire worthless and the options trader gets to keep the entire initial credit taken as profit. The formula for calculating maximum profit is given as net premium received minus the commissions paid. The maximum profit achieved when price of underlying is in between the strike price of the short call and the strike price of the short put. So, however, let's also look at the maximum loss that can happen. Large losses for the short strangle can be experienced when the underlying stock price makes a strong move either upwards or downwards at expiration. The formula for calculating the maximum loss is unlimited. Loss occurs when price of underlying is greater than the strike price of the short call plus the net premium received, or when the price of the underlying is lesser than the strike price of the short put minus the net premium received. So the loss can be calculated by price of the underlying minus the strike price of the short call minus the net premium received. Or it can also be calculated by strike price of the short put minus the price of underlying minus the net premium received plus the commissions paid. So let's look at the break-even point. There are two break-even points for the short strangle position. The break-even points can be calculated using the following formulae. So the upper break-even point is calculated by strike price of the short call plus the net premium received. The lower break-even point is calculated by strike price of the short put minus the net premium received. So here are some of the benefits of this strategy. It's the ability to profit when the underlying asset stays stagnant or within a tight trading range. As this is a credit spread position, you're already paid your full profit the moment the position is put on, and that reduces the risk. The higher chances of ending up in full profit than a short straddle. If the stock remains below the put strike price but above the lower break, even the investor will still realize a profit. If the stock remains above the call strike price but below the upper break, even the investor will still realize the profit. If the volatility is high when the position is put on, a drop in volatility after the position is put on can result in a profit. So here are some of the drawbacks of the short strangle. You can lose more money if the underlying asset swings greatly in one direction beyond either the upper or the lower break-even point. The potential loss is unlimited and can collect to a very big amount if the underlying stock continues to strongly grow in either direction. Because of this risk, the margin requirements for this strategy are fairly high. As you can see here in this image, here's the margin for the profit, and for the loss, here's the strategy for the short strangle. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free.